Okay, so this is a New York Times article. Of New York Times have kind of, even though they claim not to be, been kind of pro big business lately. What I suspect from this one, Wall Street minting easy money from risky loans. What could go wrong? What I suspect, and for what it's worth, I'm a professional investment advisor. I'm also have a degree in personal finance. What I suspect is that the big banks are just a little butthurt these days from these private loans. The banks since 2008 have had the shackles on them, if you will, a little bit more regulation than some of these private loan entities. But what's really going to determine if this is true or not is if what the default rate is and how many basis points they're charging above what the some of the traditional lending is doing. So let's take a look.
Heavyweights have been raising concerns over the private credit market. Check out today's New York Times article, Wall Street is minting easy money from risky loans. What could go wrong? It dives into what they call a shadowy world that lends money to high debt, risky businesses at high rates for fast cash. But our next guest is urging investors to tune out the noise, calls private credit a very compelling asset class. Alona Gordick is senior investment strategist at Churchill Asset Management. Alona, great to have you with us. You say now is a great time. So what about the environment right now makes it a great time, whether it be the interest rate backdrop or the macro backdrop?
So it's a really interesting time.
So what she means by that is the interest rate backdrop or the macro backdrop is since interest rates were so high, people are just been dying for loans. And the macro condition, which she means by that is, the economic engine is starting to fire up a little bit again. Partially due to the drop of interest rates, even though that's a more, you could kind of go down a rabbit hole with that statement because there's some disconnect between the discount rate and some of the other rates. But I digress. We'll watch the video.
Private credit right now, we're seeing a transition to its really next era of growth. Certainly the first part of growth here being evolutionary and structural, but really big drivers here are the race for retail, I'd say, opportunity to bring private credit to individual investors. But if you step back and you think about the real origins of private credit, it's been around for over 3 decades. Long-standing managers like Churchill and others have really been financing small to medium-sized businesses through different cycles and rate environments. So today we're looking at private credit nearly $2 trillion, up nearly 10 times from 2009. But going forward, we think the opportunity set here, addressable market, more like 30 to 40 trillion, including investment grade and assets on balance sheets of banks, which really may belong on the private credit side. So on top of that, we do see a lot of white space here. 200,000 businesses considered middle market in size for the private space, and really only 5% of those today with private capital investments. So huge white space opportunity.
I think that the headlines, came out about when interest rates were very high, and you're hearing about 12% loans because people can't get, or companies can't get access to traditional credit. Alona, so what sort of environment is it if the interest rate environment is more benign and interest rates are falling?
Sure.
Well, it's obviously going to pick up, right? Because even, it could go either way. So if the rate's lower, then there's less, there could be less risk, if you will, because there's the principal amount and the interest amount, and these things add up. And if the interest rate decreases, then you can actually, as a company, afford more, right? You don't have to. If you look at what's coming in revenue and profit versus what's going out in your debt, and because of the interest rates decreasing, you can actually afford more. So I don't know if the private credit industry would like that. I think it's been a great alternative for businesses and other entities in this period of high interest rates.
I think interest in the asset class continues to be steady and growing despite what we're seeing in rates.
She would say
While
that
we did
because she's
see a
representing
cut,
her company.
and then at least 100 basis points now from 2024 here, we do think that investors do think that the all-in yields here are still quite compelling as you think about a premium to your public alternatives. And if you think about that, the premium has generally been somewhat steady in that 150 to 250 basis points range.
So what she's saying is that they charge about a point and a half, 1.5 percentage points higher than the traditional lending institutions.
So really an attractive all-in yield that may come down, but our conversations with advisors today have really centered around education about why all-in yields are at historical highs right now. And that's really from the lift of base rates, right? Not necessarily spreads widening out as much, but base rates. So it's been about when, not if, rates come down, and really getting advisors and their clients comfortable with that longer-term picture of a nice, attractive all-in yield, despite where rates are going.
Where are all-in yields now versus at their peaks?
So one of the benefits of listening to this channel is you start getting a better vocabulary when it comes to finance and business. What they mean by all-in yields just could be everything from the interest rate you pay. If it's a bond, it could be the coupon rate. Even though they're not talking about it in this instance, it could be the fees associated with the loan. So basically everything put together.
In the last year or two?
Last year or two, I'd say we probably touched that 11-12% arena. Mm-hmm. And if you think about 100 basis points of base rates coming down, you get that in there. Plus, spreads have tightened up across the board, across all credit asset classes. So you're seeing rates all in yields really coming in that 8 to 10% range and arena. But historically, what we've seen in private credit deliver more of that 6 to 8% asset class, we'll call it the last 13 to 15 years, and really attracting a lot of interest in that low rate environment that we had been in. So I'd say coming in about 8-9% is still quite attractive to where we've been at before.
But even the worst case scenario, in your view, in terms of reverting to historic all-in yields, it would still be 6 to 8%, which doesn't seem that bad. But how does that compete with returns on the stock market? How should investors view this as part of their portfolio?
Sure. What we think about.
So basically what she's asking is, so for example, if you're going in the fixed income markets, right? And when you build a portfolio, it really depends on suitability and where a person's at, what their needs are and everything like that, right? So fixed income would be, if they're securitizing those loans that they're getting, she's getting towards that. She's also getting that. She's also asking about the growth of her own company, and I don't know. We'll see what she says. And she's comparing that to what the stock market's doing of itself. So what's a better investment, basically? What's going to give you a better yield?
At Churchill is not necessarily where rates are at, but really the best credit selection that we can make, because what we want to deliver at most is really minimizing or limiting loss, right? At the end of the day with debt, you're really just going to get your principal and interest back. So when you think about all-in yield, it's more of a relative game than absolute value here. So if you're 6 to 8 or 8 to 10, what you want to make sure you do is minimize losses and defaults. And this asset class historically over the last 22 years has shown resilience in terms of showing a much lower loss rate versus broadly syndicated loans or the public alternative.
And that's the question, right? So the what could go wrong question at the beginning of that New York Times article, if their default rate is less than traditional loans, then at this point, there's really nothing to worry about, right? It's kind of benign.
For loans or high yields as well.